Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. Hello and welcome back to Cash Talk, and today I'm joined by Amph. Amph, how are you, mate?
Good, thanks. Yourself?
Oh, mate, feeling a little bit under the weather, to be honest with you. It's been going around. I've been speaking to a lot of people, and the Cachia household copped it a little bit. So a little bit nasally, but, sunshine's actually coming out a few times of the week. So, getting out and trying to enjoy that sunshine, but a bit nasally if you can hear me on that.
Yeah, can hear you. Not sounding too good.
Yeah, might need to start getting the echinacea back up. I don't know what it is, but eager to jump into this podcast. So, Ant, a lot going on in the loan space, yeah? And we wanted to kind of delve a little bit into loans and whatnot. So I might let you get things kicked off a little bit.
Yeah, awesome. So I think today we're just going to have a bit of a chat about different features and sort of things around in the lending space. So one of the most common things I get asked about is offset accounts. Mm-hmm. So I've seen a lot of things out there online and sort of just from conversations about offset accounts, but they are probably one of my favorite things as a loan feature, offset accounts, especially multiple offset accounts. So when we're setting up cash flow plans, the multiple offset accounts works a treat. It really helps with budgeting and things like that. But just to sort of recap for those who don't know what an offset account is, the easiest way to think about it is in a normal savings account, you put your money in, the bank pays you interest on your savings. Whereas an offset account sort of works like the opposite. You put money into this offset account and it saves you interest that you need to pay on your loan.
Yeah, so essentially it's just a bank account that's attached to your home loan. And let's say you've got $10,000 in that offset account and your home loan is $100,000. You will pay interest on $90,000, which is the $100,000 loan minus the money that's in that offset account or in that bank account that's linked to that home loan, which is called an offset. Therefore, you're paying interest on the $90,000. Now, be mindful that if you're paying principal and interest, that principal payment or that payment does not change. All it means is that repayment that you're making into your home loan, more of the portion is in relation to the pay down of the principal rather than the actual interest itself. So you're saving on that interest portion. And Anthony, like you were discussing before, multiple offset accounts work a treat because you're able to really tell your money where you want it to go, and segregate your money with purpose rather than having one big bank account where you don't know where money's going. And what we end up finding is that people, when they don't know where they're going, they're overspending, which is then obviously hindering them from paying off their debt, achieving their goals and whatnot. So offset accounts are a really, really important feature, especially multiple offset accounts, in regards to getting that systemized approach in regards to achieving your goals.
Yeah, and I think I've mentioned this in the podcast before, that one bank account cash flow setup is probably my pet hate. So having those multiple bank accounts where you can sort of have your savings, your bills, your spending money, however you've got your finances structured, you can have multiple offset accounts and they're all going to be offsetting your home loan. So the difference is if you have one offset account, only that one offsets a loan, but you could have some banks up to like 100 offset accounts, and each of them will contribute to offsetting the loan, which is
and
really
especially
good.
It gets dangerous when you've got that credit card that's linked to that offset account, and then essentially the offset account becomes this kind of extended credit card limit of the credit card, and so even though people say, my credit card is paid off at the end of each month, are you actually paying down your debt, or is it every 3 or 4 years you're refinancing, cashing out that equity to then replenish your offset account? Therefore, just really you're paying off your home in a much more longer period of time. So be mindful when credit cards are there. But and there's a few other things to be mindful of when it comes to home loans as well too. One of them is in regards to the actual structure of the loan itself, being, is it variable, is it stepped, and there's different elements of the loan themselves. Now, a lot of people that we see are on variable home loans. Variable home loans, essentially, as interest rates go up, the rate in which you're paying goes up. If interest rates come down, your rate usually comes down. Whereas a fixed loan is for a period of time in which the rate is the same for that period. So you might get something that's 1 year fixed, 3 year fixed, or 2, 3, 4, 5 year fixed. And that is the rate that you pay. Now, fixed home loans are usually good for certainty. Okay. So I need to know that a particular amount is going to come out and I can't adjust that. I want that certainty. So you may fix that loan. Variable is going to be fluctuating. Yeah. Now, a lot of people say, should we go fixed? Should we go variable? Well, really, you're kind of, you're taking a little bit of a gamble each way. Yeah. Because, if you think that interest rates are going to go down, well, then probably a variable rate is more suitable but it also depends on how many rate cuts there's going to be and what's applied. But also, if interest rates are going to go up, you might want to take a fixed rate to then try and, lock in that fixed rate. But the thing is that lenders aren't so silly, so they price these fixed loans with their own actuarial study based on what the money is lent to them from the central banks to then figure out what that fixed loan is going to be. And a very good one was where the fixed rates were, 1.99 or 1.97 and, people fixed because they were literally getting money for nothing, and so they were still making that margin, and people that went on those fixed rates really won that play or that prediction. However, did they kind of repay at the levels that they were going to go back to? And the reversion rate was much higher than what that rate was before. But still, during that period of time, they probably did very well. So you can see where it works well, but obviously when it doesn't work well, has been periods where people have locked in much higher interest rates and then interest rates have gone the other way. And this was very prevalent about maybe 10 years ago where people were locking in a longer term fixed interest rates and interest rates really came down. And when interest rates were around the 3 to 4% range, people were still paying at 7.5% or 8%. And the cost to kind of get out of those fixed loans, because they do charge a penalty to get out of those, were really substantial. So I really kind of look at those two factors to say variable home loans are for people that can kind of don't need the certainty and are willing to ride the economic kind of cycle. Fixed loans are more for people who want to have more certainty in understanding what the repayments are going to be. And that might be, for example, someone's going on maternity leave or someone needs a stable kind of scenario really clear for them. Then there might be a fixed loan or a combination of both, which is most likely what we see when people are going fixed. They will try and give combinations because there's also limits in regards to how much you can pay off your fixed loan as well too, Anthony, isn't it?
Yeah, correct. And even with the offset accounts, like you can't offset. I mean, most lenders don't let you offset a fixed portion of your loan, whereas variable you can. You got much more flexibility with variable. You can chop and change things, whereas fixed you are essentially, as it says, fixed into that sort of contract, and they usually range from 1 to 5 years. Is usually the fixed term that you're able to get.
Yeah, and so you got to be very mindful on how much you can actually repay that fixed amount. So in most cases, we do see a split scenario where there's like if they're going to go down the fixed path, there's a percentage that's fixed and a percentage that's variable.
Next one that's pretty common that I often have conversations about is equity and how equity in your home works. So one of the sort of most attractive things with property is actually equity and being able to get equity out from the bank and use that equity for other things. So usually the way that banks calculate it, sort of on a standard basis, the way that it usually works is you can borrow up to 80% of your property value. You can borrow up to 80% of your property value and use that money for other things. So
and above 80%, you usually get into what they call lender's mortgage insurance territory, okay? So there is some banks that let you do a little bit more than 80%, but for all general reasons, let's keep it standard, 80%. Above that, you pay a thing called lender's mortgage insurance, which is an insurance that you pay on behalf of the bank for going above those, let's call it safety levels. So let's say your loan to value ratio, so you had to borrow up to 90%, you would pay an insurance for the bank to say, hey, listen, we're going above that level. This is the insurance I need to pay because if you default on that mortgage, they want the level of security through the insurance policy and your home to be able to get their money back.
And even with that, when you go over 80% LVR, you usually get penalised with a higher rate, but also the criteria is assessed a little bit more stricter. So to get equity out above 80% is actually quite hard.
Yeah.
To borrow above 80%, not too bad. Like you've got that 80.
Below 80%, you mean?
Yeah, sorry. So that but you got that 80 to 90% mark where, yes, you can pay the high rate, pay the LMI, and you should be able, like you can borrow a bit more money. Above 90% is when it starts to get very difficult, and the rates you see are probably can get up to like 2%
Yeah.
more.
So lenders get smaller. Then because there's less competition, it means that the rate in which you need to pay is much higher as well
Correct.
too. So the equity is based on the valuation of the property.
Yes.
Yeah. And then obviously the current loan that you've got. And let's say for argument's sake, you've done that 80% of the value of $1 million property. That valuation of 80% of $1 million is 800,000. You've got a loan of say 700,000. You can then borrow an extra 100,000 as long as your like income and your credit scenario stacks up. You can borrow that 100 grand. Now, the problem you've got with this is that a lot of people are doing this and funding their lifestyle. And I've spoken about this kind of debt-fueled society. This is where this is coming from. Yeah, where they're using this equity for bad reasons.
Yeah.
They're using it to fund their lifestyle, to clear up their existing debts on their personal loans. Like, don't know that clearing down those bad debts is important and in some cases very valid. How did you get into those debts in the first place?
And on that too, like the bank's not just going to let you increase your equity for no reason. You usually have to have a purpose for it. So it's either like you want to borrow equity to buy another property, or you've got some debt you want to consolidate, or you've got
renovation,
car renovation. So there's a few different reasons. But on that too, in saying that, what was I going to say? So yeah, I lost my train of thought.
Oh, it happens to me. It happens to me. But yeah, so it's very, very important when you're doing these exercises to understand that there is kind of criteria to be able to do this, but also be mindful of what you're doing it for. And a very common question that I ask people when they say, "Oh, cool, everything's under control. We've only got one debt," and is okay. How much did you buy your house for? Oh, we bought it for $1 million. Cool. Okay. How much was your loan back then? 800 grand. Okay, cool. All right. So why is your mortgage now 950? Yeah. Why is it 950? And you can see sometimes people like they have to stop and go like, yeah, that's true. Or even if it's just like, oh, it's still 800. Oh, how long you had this mortgage for? Oh, 5 years. Well, if it's a principal and interest loan, that loan should be not should be more or not even the same. It should be less simply just by the principal payments. But if it's also higher, they've got into the motion of using their debt to fund their lifestyle. Yeah. And that is the concern of using this equity. However, using the equity for good reasons can also be very good as well too. And this is where the buzzword about that debt recycling kind of gets in. And debt recycling is when you use the house you live in for all intents and purposes, that's non-deductible debt, to convert that into deductible debt to help you build wealth. Okay. So let's say, for example, a house is worth $1 million. You've got a debt on it for 500,000. We know that we can borrow up to 80%. So we can grab $300,000 and we can use it for reasons. One of those reasons can be to buy investments. So let's say we grab 300,000. We put that 300,000 into the stock market. I don't know. Let's just go with the ASX 200 for now. And then that $300,000 loan, which be careful, make sure it's split for tax reasons to make it very easy for your accountant. But that $300,000 is put into the stock market. Stock market earns an income through the form of dividends. And then those dividends pay back that loan, that the non-deductible debt first, and then the remaining into that deductible debt, because you want to pay the non-deductible first, then the deductible second. Doing it that way can be beneficial. Now, there is pros and cons to this. Okay, first thing is you've got to be able to tolerate the risk doing that. You're going into investment properties, you're going into stocks to be able to do so, and both are volatile, both are risk assets. You might put $300,000 in hoping that $300,000 is going to be $700,000 in 5 years' time. Go speak to the people that did that in the global financial crisis.
And it's also the time horizon too. You're not doing this for a short-term play. You're going to go through this strategy. It's something that you need to be prepared to do for like 8+ years to let cycles run through and things like that. But
it needs to be a very unique scenario for me in the first 12 months to recommend a debt recycling strategy. Because of the whole behavioral side of things and really understanding the client and how they're going to kind of react to that certain thing. And whenever you use gearing or borrowing funds, you're essentially putting a magnifying glass on the potential gains, but also on the potential losses. Most people focus on the returns they can make and don't focus on the losses. And that is very important that you need to focus on. Could this wipe you out? If your $300,000 went down to $150,000, could you survive? Do Do you have the cash flow? Do you have the time horizon? Do you have the gut to be able to ride that out? Yeah. So that's where equity can work well. And I don't want to kind of discount it for everyone. I just want them to say that using it for investment purposes can be a good thing. And in most cases, nearly all cases, it's going to be better than, using that to fund lifestyle. Yeah.
But also, like with that, probably the most common one I actually see is people leveraging a property to purchase another property. Because what you usually see is back to that 80% rule. You can borrow 80% of a property value. So when you go to buy a property, you can get, say, a loan for 80% of that. The other 20% and costs like stamp duties and all those other fees usually comes from the form of equity from your current property. So you look at getting 20% equity from that current property plus the cost plus the 80% loan for the new property and use that to purchase that new, let's say, investment property with borrowed money. The advantage of this is usually that money now that you've used to purchase that investment is all tax deductible. So there are some benefits to that where negative gearing may come into play. But also a common thing that we see is the structure of the loan, principal and interest only. Remember very early on when I was in school, I didn't fully understand the concept of why someone would borrow a loan on interest only and never pay it down and only want to pay interest on that loan. But when you actually look at the reasoning behind it, it's a very effective strategy that, depending on your situation, may work very well.
Yeah, and I think this really comes into play when you've got non-deductible debt and deductible debt. So you always want to pay the non-deductible debt off first, which is the house you live in or credit cards and personal loans and stuff like that. You want to pay that down first. So you want to smash that. You want to destroy that. But your deductible debt, you want it to be last. So if you've got a principal and interest loan repayment going down to pay down your deductible debt, you're actually slowing down the ability to pay off your non-deductible debt.
Oh, and I was going to say is with that as well, like when you're paying principal and interest, only the interest component of the loan is tax deductible, which not all people know. Yeah. So when you have an interest-only loan for an investment, that loan is fully tax deductible, whereas
that repayment is fully tax deductible, whereas principal and interest, it's only the interest as well. So it's essentially the same. Yeah, it's only the interest portion. The other thing to know about debt, if managed well and set up correctly, is also a depreciative thing. Okay, so I want to explain this concept because I actually had to explain this to someone a couple of weeks ago now. So let's say you borrowed $100,000 today on an investment. Okay, yes, you got to pay the interest payments. I totally get this. Yeah, but for $100,000, what can you buy now? Let's say you can buy a really nice car for all intensive purposes. Okay, you can buy a nice car, $100,000. In 20 years' time, what can you buy with $100,000? Well, most likely it's not going to be the car that you had. Let's just call it a nice Mercedes for all intents and purposes. That $100,000 is probably at best going to get you a base level entry point, maybe Chinese version cheap car at the moment. So, but the debt's still 100. So it's a depreciative thing as time goes by. So, and I try and say to people, if you got that against an appreciative asset, let's put this in real terms, like with a house. Let's say I've got a house worth $1 million and I've got an $800,000 debt. 10 years, 7% returns, let's say, that $1 million property is now worth $2 million. But my loan's still worth $800,000.
Well, actually less if you've paid it down as well.
Yeah, but just say it's interest only for this intensive purposes. You can see how it's, once again, not only a depreciative asset, but you've put it towards an appreciative asset as well too, to therefore create equity, which can then be used to compound. Where this kind of gets unstuck is cost of holding property. Yeah. The rates as well too on debt. So once you take total return, so capital growth, income, then minus expenses, all expenses, what's the actual net return? So going from one property to another, yes, it can be a great idea. And there's a lot of people on social media that are talking up, buying this property, creating a massive portfolio. We are unbiased in regards to property or stocks. Couldn't care less as long as it's right for my clients. But two factors is, one, don't put all your eggs in one basket. You've heard that before. We all know about that. Diversification is a very important risk management tool because we cannot have all of your eggs in one basket. If a market is exposed to a crash, your whole situation will be wiped out. Okay. Second thing is, from an income generation tool, property is not a great tool. Have a look at the actual income you're earning after all of these expenses. And in most cases, it's better for you to put your money into a bank account and you'll earn more these days. Yeah. Third thing is liquidity. So you can't sell a bathroom if you need money. So it's not to knock property. Property is very good. Being able to leverage from it to grow wealth. We just talked about how powerful it can be. But yes, I see a lot of people doing it. I see in social media a lot of these big names on social talking about getting all of these properties and whatnot. When we're actually running the numbers properly, and I don't know how in some cases, I don't know how they're convincing people to do this. Yeah. But you see some of the numbers and...
Yeah, it's crazy. Well, Steph, my fiance, she's a property manager, and I hear all the problems with property and expenses, unexpected costs all the times, difficulty with tenants. So
that's on top of all that.
That's like you could put that with on top of land tax and interest rates and rates and things like that. There's a lot of outgoings for the property. And I actually had this conversation earlier this morning with someone where if you're going to buy a property, you should be looking at the property for the long-term appreciation of the asset, not for the rental income, because 90% of the time, especially where rates are at the moment, you're going to be having to top up that, like, you're going to have to be putting more money towards that loan plus the rental income just to cover the interest, let alone the other costs.
Yeah.
So
you shouldn't be going into property to generate extra income if you don't have the income to service it.
Correct.
Do you know what I mean? Like, obviously we see a lot of good clients that do really well and they've got really good sustainable cash flow. Yeah. And they could actually sustain the properties not even being tenanted. Like the rental income's actually bonus and the tax implications that they're getting is bonus. And unfortunately, that's the rich getting richer and the poor getting poorer. But from an actual, hey, let's buy an investment property because we want to kind of get passive income, go speak to a real estate agent that handles rentals long enough and they'll tell you there's not much passive about it. Yeah. Anyway, a lot in the loan space, especially from interest rates as well too, Anthony, which I want to touch on. RBA's recently come out, cut interest rates. They've come out and talked about a stance about they want to see certain metrics kind of be stabilized or not come down. The RBA governor was pretty much talking about, don't count on rate cuts happening. Yeah. But as well too, banks are getting more aggressive in competition. Okay. Not only for our retention teams becoming much more aggressive in regards to retaining their clients and offering good rates, but also as well too, there's a lot of people that have been complacent in regards to reviewing their loans. And so one of the ones that I want to leave on right now is like, if you haven't reviewed your loan in maybe 2 years, you need to be. Yeah. And really you want to kind of review your loan. You don't want to review it too often. I think it's pretty overkill. Yeah. But, at least probably once a year, check it at an absolute must every 2 years, because you want to make sure that your current lender is being kept accountable. And if there are better options out there, well, what can you do about that as well?
Yeah, so obviously having a look, because there's a few different options you've got. You either you speak to your current lender, you get some have a look. What can you do with the discount on the rate? Most rates that people have, you've got a discount on them. So that changes all the time. So you can have a look to get a better discount on your rate. Have a look. There's sometimes other lenders offering more competition, and each lender has their own specialty too. Like some lenders will give you a really good intro rate to start off with, but then they forget about you. Some lenders really look after their customers, but then also the structures and features. Is your loan structured correctly? Do you have the right features? Like earlier today, we spoke about multiple offset accounts or even offset accounts altogether.
Do you have equity tied up in the property that you can maybe use elsewhere? There's so many things that are structured with the debt. It's not a set and forget, definitely. Yeah. Even in regards to repayments, what your repayments, have your repayments changed? Should I be keeping it at the same level? Should I be doing more? These are constant conversations that we're having at the moment. But hopefully today's been valuable. I know it's been great to dive into loans. I don't get to do this much often. So thanks for jumping on and explaining your side of things, Anth. But if you're loving these podcast episodes, make sure you share to all your friends and family, and make sure you like and subscribe on all major channels. But thanks for joining us today, and thanks, Anthony.
Cheers. See you guys.